Hi everyone, welcome back to the channel. Happy Tuesday. It's right now, motorbike going past. It is Tuesday the 12th of December right now, if you're kind of watching videos back. The point I'm going to go through today is apparently that multifamily deals in Los Angeles have reduced 77%, which they're saying is kind of result of the full brunt of the economic slowdown. Now, apparently, there kind of has claims that the LA apartment market is on the rocks, and that is coming from a conclusion from Yardi Matrix from a new report saying there is sluggish rental growth, diminishing with demand, and a return to lower but historically average construction starts that are dogging the city. So I think this is a really interesting point. It's something that we've spoken about briefly before, which is that commercial real estate and multi-unit residential is kind of commercial in LA or in the US. If you're not aware, there is a difference between condominiums and apartments. In London we call them all flats, and that's kind of your, not a house, division or a small property that's normally connected to other properties. However, an apartment in the US, they're sold as bulk. So an apartment building are only available per unit to rent. Condominium buildings, you can buy a condominium. So apartment buildings really are one investor that is going in. They are creating or buying a property that is full of rental apartments. You cannot divide up those units and sell them off. Well, you can, but that's very rare that that happens. And it's not like you can go into a rental building and say, right, I want to buy this as a condo. However, there are condominium buildings where obviously you can rent out privately your own condominium, your condo as it's called. So guys, this is an interesting one. Basically saying the LA apartment market is having a significant downturn. This is 77% since last year, which is a huge decline. Almost coming down basically three quarters, over three quarters of what it was happening last year. We have obviously seen changes in the economy and slowdowns in investment. And as I've said, rental is actually strong here, but a lot of those commercial buildings, especially retail and office spaces, are not finding tenants. So I have got, in my own opinion, there's a few factors that are contributing to this. One of which is the economic decline or impact that we're seeing. The cost of living has risen with inflation. Therefore, what people are willing to spend on rent is not increasing at the same rate as inflation is. I think we have seen an increase, but a very, very small increase in the kind of average rent that a unit is getting. However, the cost to build them is significantly higher. Now, another reason that I think this is because that there is so much demand right now in homes, more houses for people to do work, and therefore contractors have got a lot more demand. So a contractor right now is getting a lot of calls from your end user, your person's owned their house and they're wanting to do work on the property, whether that's an extension, whether that's redoing it, because they do not want to buy a new home and effectively pay the new mortgage rates, which are 3 to 4 times what they used to be and probably what they've had in the past or what they've locked their 30-year rate into being. So obviously, if you are an owner of a property right now, you're not as interested to sell it and to buy a new one as you have been. And if you're in your house, then you may want to do some changes, whether that's renovating it, as I said, doing an extension. So I think contractors are harder to come by, or there's more work for contractors, which means if you are looking to do a development, the cost to do that is going to be significantly higher. Now, I'm sure you can find contractors, but what it does mean is if you're looking at this is the price of rent per unit that I'm going to get, it is not going to make financial sense to buy it in the same way. And so apparently the average sales price per unit has actually dropped 25% to 325,000. So they're not going to be getting the same increase in rent that they were going to be getting. So therefore, it's 25% drop in the average value of one of those units. Yeah, so we've seen a small marginal increase to an average of $2,592 per month. So $2,600, which is a huge amount of money. As I've said before, it's very expensive to rent in LA. But if it's not seeing a big increase, then you're probably not looking at developers that are wanting to do, especially smaller projects, maybe projects at scale where there is a good return margin there. They may be more interested in that. One of the big things that I think is an impact on this is something also I've discussed before, which is measure ULA. This means that if you are doing purchases of properties that are over $5 million, you're paying about a 4.5% transfer tax. That's being cash paid at the point of sale. The other thing is over 10 million, it's about 5.5%. And that's general figures. I don't want to be specific on that. But obviously, before it was kind of geared as a mansion tax. You know, people were saying, hey, let's raise money for the homeless by doing these taxes on these expensive $5 million, $10 million houses. $5 million is a lot of money. It does not get you a mansion. And what they didn't really tell you when voters were voting on this bill during the midterm elections is that it was for all real estate. So that is apartment buildings, multi-unit residential, it's for commercial buildings, everything. It's not just mansions, it's not just residential. So therefore, I think a lot of developers probably are looking at this, and if they build a house, or sorry, build a multi-unit apartment building, if they want to resell that in the future, they have to factor in another 5% or 4.5% of what they would potentially get as a return. So again, if you're looking to flip this, buy a piece of land, build an apartment building, and do that, then maybe it doesn't look as attractive. So you're not going to bother going down that path, especially maybe if the economic outlook is not as positive as it has been in previous years. Also, with the actual purchase of land to do this, you obviously need a large piece of land to build an apartment building a lot of the time. And if it's in a good location where it's going to get good rent, it may well be more than $5 million. A lot of developers look at that 5% return as kind of what they would expect to get back from a property. So therefore that's wiped out, which means they need to make more money than that. And if you're only seeing small increases in the rental prices of each unit, it makes sense to me that you wouldn't necessarily see that. So that could be a massive reason that actually you're seeing this decline in property, in actual sales and building of these multi-unit apartment buildings. What I also said this is reading more into this, but what I also said when ULA first came out, and we were talking about how ULA is going to affect multi-unit residential, is I think it really does, its worst effect is on renters. What it leads to is a situation like this where you're not seeing much more supply come to the market. Therefore, people aren't building these buildings. So the price of rent is only going to go up. It's a demand and supply situation where if you've got more demand, which LA has constantly got because people want to live here, it's an amazing city to live in, the weather's great, there's a lot of opportunity, people are not going to want to not come here. So therefore the demand is going to be constant. And if you're preventing people from building these buildings or from buying them, it means that you're actually just going to have a situation where rent is increasing and increasing. So those kind of middle of the road properties where they're affordable but they're not ridiculously expensive, that is going to go away, because if an investor or a builder is now going to build a home or renovate it or buy it off someone else, they're going to want to get the maximum amount of rent that they can, which means that they're going to do a lot of very luxury residential, very luxury, what am I thinking of now, work to redo the property, construction that's actually going to make it a lot more expensive. So therefore you're going to have properties that are much higher in cost than they are now. And the other side is that if you own an apartment building, you probably aren't going to sell it, and you're not going to spend a lot of money on it because you know that investment isn't going to return. So I think what's going to happen is you're going to get a split, very, very expensive rent, and these properties which have to make a lot of money to make it financially viable, and buildings that are going to go into decline. Right now, these buildings may be in good condition. However, they are not going to be generating the want or the desire from landlords to be spending a lot of money just to stay at the same rent. So guys, I think this is again an interesting one to look at. I'd love to know if you disagree. But actually, the fact that it is such a huge decline at 77% was a real shock to me. And that is just from last year to this year. We're not looking at, 5 years out. I think it's going to be really interesting to see what happens next year. Anyway, guys, thank you so much for tuning in. I'll be back tomorrow with another video. It's been great spending my time with you, and thank you for giving me that time. If you'd like to subscribe, set notifications, write a comment below. I'd really appreciate it. Thank you. Goodbye.